Hello everyone, welcome to the market opening bell for Monday, September 29th, your 10-minute guide to the stock market. Hong Kong stocks opened lower last Friday, lacking upward momentum. The Hang Seng Index opened down 213 points with a decline narrowing to 79 points in early afternoon trading, reaching a high of 26,406 points. However, the drop widened again later, hitting a low of 26,073 points, down as much as 412 points, and closed at 26,128 points, down 356 points or 1.3%. The Hang Seng China Enterprises Index closed at 9,303 points, down 141 points or 1.5%. The Hang Seng Tech Index fell 184 points or 2.9%, closing at 6,195 points. The total market turnover was 323.6 billion Hong Kong dollars. Southbound trading turnover was 160.9 billion dollars, with net southbound inflows of 10.54 billion dollars. Among them, net buys include Alibaba at 2.412 billion, Horizon Robotics 863 million, Tencent 792 million, Xiaomi 605 million, XTelPai 190 million, Shandong High Speed Holdings 130 million, Li Auto 114 million. Net sales include Xpeng Motors 291 million, Hua Hong Semiconductor 212 million, and SMIC 145 million. According to statistics, southbound funds have been net buyers of Alibaba for 26 consecutive days, totaling $71.797 billion, and net buyers of Tencent for 3 consecutive days, totaling $4.554 billion. For the week, the Hang Seng Index fell 417 points or 1.6%. The China Enterprises Index dropped 1.8%, ending a 3-week upward streak for both indexes. The Tech Index fell 1.6%, ending a 7-week rise. Southbound funds saw a net inflow of 43.959 billion Hong Kong dollars last week, compared to 36.851 billion dollars the previous week. Technically, the Hang Seng Index weakened, falling below the 10-day moving average and barely holding the 20-day line and the 26,000-point level. The 9-day relative strength index (RSI) also dropped below the 50 midline, suggesting 26,000 points may eventually be lost. The next support levels to test are 25,700 points and the 50-day moving average, currently near 25,545 points. With the mainland's long holiday approaching, markets are concerned about potential profit-taking sell-offs. China's A-share indexes opened lower last Friday and trended downward. The Shanghai Composite closed at 3,828 points, down 25 points or 0.7%. The Shenzhen Component closed at 13,209 points, down 236 points or 1.8%, and the Chinex Index closed at 3,151 points, down 84 points or 2.6%. The combined turnover of Shanghai and Shenzhen markets was 2.1468 trillion yuan. For the week, the Shanghai Composite rose slightly by 8 points. The Shenzhen Component gained 1.1%, and the Chinex Index rose 1.9%. The renminbi US dollar central parity rate was adjusted down 34 points to 7.1152. Xiaomi held a product launch with lackluster highlights, and its stock fell over 8%, closing at $54.65. Xiaomi claimed that the Xiaomi 7 series sold out in 5 minutes, setting a record for 225 domestic phone sales across all price segments, with the Xiaomi 17 Pro Max accounting for over 50% of the series sales. However, this comparison is against domestic phones, and the Xiaomi 17 series is positioned against Apple's iPhone 17. Starting in October, the US will impose a 100% tariff on branded or patented drugs. Fosun Pharma and Pharma fell 5.8% and 5.9% respectively, while Rongchang Biologics dropped 4.7%. WuXi AppTec and Casino fell 3.3% and 4% respectively. The impact on China's innovative truck industry is expected to be limited as few Chinese innovative truck companies directly export to the US. Most have established production capacity in the US or outsource to local CMOs, and many adopt BD licensing models for overseas markets, avoiding direct commercial exports. For the CXO sector, Chinese CXOs mainly export APIs or biologics with a low proportion of finished drugs, many of which are generics, thus unaffected by the tariffs. Overall, the US tariffs will primarily impact multinational pharma companies reliant on overseas production, encouraging them to build factories in the US, with a manageable impact on China's pharmaceutical industry. Meituan is actively expanding overseas. Its international delivery brand Kita launched in Qatar in August, Kuwait in September, and officially started operations in Dubai, UAE last Saturday, entering its third Middle Eastern market in 40 days. Additionally, Kita introduced the Kita Premium section, featuring over 1,000 selected high-end restaurants, including Michelin starred ones, marking further expansion into the premium dining market with diversified offerings. Baidu's autonomous taxi business, Apollo Go, plans to expand overseas and is in talks with governments in the Middle East, Europe, Southeast Asia, and Australia. Baidu claims Apollo Go's economics in China continue to improve, with some cities, besides its largest fleet in Wuhan, achieving per-vehicle break-even, providing a commercial basis for large-scale autonomous taxi deployment. On the earnings front, New World reported a full-year loss from continuing operations attributable to shareholders of 16.3 billion Hong Kong dollars for the year ending June, up from 11.806 billion dollars the previous year. Per share loss from continuous operations was 6.82 dollars with no dividend declared. Consolidated revenue from continuing operations was 27.681 billion dollars, down 23%, and core operating profit was 6.016 billion dollars, down 13%. Hong Kong property development revenue was 2.696 billion dollars, with segment profit of 877 million. Hong Kong property investment in revenue was 3.234 billion dollars, with segment profit of 2.401 billion dollars. Mainland property investment revenue was 1.821 billion dollars, with segment profit of 843 million dollars. As of June 30, the group held a land reserve of approximately 7.14 million square feet in Hong Kong for immediate development, including 3.38 million square feet for property development. The net debt ratio rose 3.1 percentage points to 58.1%, with total debt at $146.1 billion, down $5.7 billion in financial year 2025. Net debt was $120.1 billion, down $3.5 billion, and short-term debt was $6.6 billion, down $35 billion. The group completed loan refinancing and coordination of approximately $88.2 billion by June 30. US August PCE price index met expectations and US stocks rebounded last Friday. The Dow Jones closed up 299 points or 0.7% at 46,247 points. The S&P 500 rose 38 points or 0.6% to 6,643 points. The Nasdaq gained 99 points or 0.4% to 22,484 points. The Nasdaq Golden Dragon China Index fell 135 points or 1.6% to 8,530 points. For the week, the three major indexes fell each by less than 1%. Tech stocks show mixed performance. Tesla rose 4%. Amazon and Microsoft gained less than 1%. Nvidia rose 0.3%, while Apple and Meta fell less than 1%. Intel continued to rise by 4.4%, reportedly in talks with Apple. TSMC, and others. Boeing gained 3.6%, reportedly set to receive relaxed production restrictions on the 737 MAX. Electronic Arts surged nearly 15%, reportedly facing a potential $15 billion privatization. On economic data, U.S. personal spending in August rose 0.6% month-on-month, above July 0.5% and market expectations of 0.5%, marking the largest increase in 5 months and showing consumer resilience despite rising economic uncertainty and borrowing costs. The PCE price index rose 0.3% month-on-month in August, following a 0.2% increase in July, in line with expectations. For core PCE price index excluding food and energy rose 0.2%, matching July's increase in expectations. Year-on-year, overall PCE inflation accelerated from 2.6% in June and July to 2.7%, the highest in 6 months. Core PCE inflation remained stable at 2.9%. Both annual rates met expectations. The University of Michigan Consumer Sentiment Index for September was revised down from 55.4 to 55.1 compared to 58.2 in August, marking the second consecutive monthly decline and hitting a low since May. Inflation expectations for the next year were revised down from 4.8% to 4.7%, and 5-year expectations fell from 3.9% to 3.7%. This week, key economic data includes the September ISM manufacturing and services PMIs on Wednesday and Friday, respectively. If they confirm the weak business activity shown in S&P Global's preliminary PMIs, it may reinforce expectations for more than one rate cut next year. The ADP private payrolls report on Wednesday will provide the leading employment signal, while Friday's September non-farm payrolls report will be critical, as the past two reports significantly underperformed expectations, with substantial downward revisions indicating a clear slowdown in employment growth. Our stock pick today is GuoFu Hydrogen Energy Equipment, stock code 2582. GuoFu Hydrogen Energy Equipment primarily engages in the production and sale of hydrogen energy equipment, maintaining a leading position in the domestic market for onboard hydrogen supply system products. From June 19 to June 30, 2025, the Ministry of Industry and Information Technology announced a total of 1,248 fuel cell vehicle models, of which over 500 models were equipped with the group's onboard hydrogen supply system products. In the hydrogen refueling station equipment market, the group's business has been steadily expanding, according to the China Hydrogen Refueling Station Database by GGII. As of June 2025, a total of 527 hydrogen refueling stations have been built in China, with the group providing equipment and supporting services for over 120 of them. In the field of hydrogen liquefaction, the group is actively exploring an integrated business model encompassing green electricity to green hydrogen production, plus green hydrogen liquefaction, plus green hydrogen transportation, plus green hydrogen refueling, plus green hydrogen transportation applications. In April 2025, the group established a joint venture in Dahan, Mumingan United Banner, Inner Mongolia. Inner Mongolia Huafa Hydrogen Energy Technology Company Limited to lead the development of a wind power-based green hydrogen production and liquefaction ecological project. Additionally, the group has made breakthroughs in the overseas market for water electrolysis hydrogen production, delivering its first batch of demonstration alkaline water electrolysis hydrogen production equipment to Indian clients. The group is actively expanding its overseas cooperation and business layout. aiming to promote green hydrogen projects in relevant regions next year through technological and product advancements and comprehensive collaboration with overseas partners. It also seeks to reduce manufacturing costs and improve production efficiency by setting cost reduction and efficiency enhancing goals, gradually achieving economies of scale to lower production costs and enhance profitability. Since February 2025, the group has been exploring potential overseas hydrogen energy investment projects through its overseas joint ventures and business partners. After thorough evaluations, site visits, and management discussions, several high-quality overseas projects with favorable conditions and practical feasibility have been identified, including hydrogen refueling stations, hydrogen production equipment manufacturing plants, liquid hydrogen facilities, and water electrolysis hydrogen production projects located in China and other countries. The group continues to actively collaborate with local joint ventures and upstream and downstream industry partners to advance potential hydrogen energy projects. Looking ahead, the group will adopt a closed-loop model to integrate upstream and downstream resources in the hydrogen energy industry, forming a complete industrial chain from hydrogen production, storage, and transportation to refueling and hydrogen vehicle applications, promoting the large-scale and cluster development of the hydrogen energy industry in the region. The group will continue to leverage synergies in its business lines, such as onboard hydrogen supply systems and hydrogen refueling station equipment, to drive new developments in the commercialization of fuel cell vehicles and hydrogen refueling stations through the development and demonstration of innovative liquid hydrogen products. It will gradually increase the revenue proportion from hydrogen liquefaction, liquid hydrogen storage and transportation equipment, water electrolysis, hydrogen production equipment, and related products. Recommended buy price 64 Hong Kong dollars, target price $70, stop loss $61. I do not hold the aforementioned stock.